Okay, let's try and unpack this because it's pretty wild. Imagine a tiny company, right? Barely on anyone's radar, stock trading for just a few bucks.
Mm.
Then boom, in a single day, its value explodes. We're talking over 400%. This isn't made up. This actually happened to SharpLink Gaming, ticker SBT, on May 27th, 2025.
Yeah, a micro-cap iGaming company suddenly looking like some kind of crypto-fueled rocket ship.
Yeah.
The big question is, what on earth happened?
Exactly. Welcome, everyone, to the deep dive. This is where we take the sources you provide, articles, research notes, whatever you've got, and we really
Wow.
dig into them. We try to pull out the crucial insights, the stuff that actually matters.
And today, yeah, we're diving headfirst into this really extraordinary transformation of SharpLink Gaming.
And we're going to unpack the before and after of SB, try to figure out what drove this, well, astonishing pivot, and maybe most importantly, what it all really means for investors, for the market. We've got a stack of material provided by you covering SharpLink's history, the intricate details of this sudden shift, and of course the market's absolutely wild reaction.
And all those sources we're drawing from, they're linked right there in the description, so you can follow along, check the details yourself.
Definitely do that.
And maybe as we go through this, keep one kind of central question bubbling away in the back of your mind. We'll come back to it at the end.
Okay.
Is this radical pivot by SharpLink, is it a brilliant strategic masterstroke? You know, maybe paving a new way for public companies? Or is it perhaps just a massive gamble on a super volatile asset just wrapped up in a corporate structure?
That's a great framing question, something to chew on.
Yeah.
Now, before we really jump into the weeds, just a quick word. These deep dives, they're made possible by insights synthesized using tools like Stock Analytics AI.
Mm-hmm.
And if you want us to tackle a specific ticker symbol or maybe do a deep dive right after an earnings call, you can actually get your requests prioritized.
How does that work?
Just become a member for only $4.99 a month. Head over to the Stock Analytics AI YouTube channel. Seriously, search Stock Analytics AI, hit subscribe while you're there, maybe drop a like on this video if you find it useful. It honestly makes a huge difference for us.
It really does.
All right, let's start at the beginning. Before all this drama, what was SharpLink Gaming? What did their business actually look like?
Okay, so historically, SharpLink Gaming operated as basically an online performance-based marketing company. Their main job was connecting potential players with online sports betting sites and iGaming operators.
Right, so kind of like an affiliate model, sending traffic, getting paid for it.
Exactly. Performance-based commissions, things like CPA cost per acquisition, where they get paid if someone signs up and deposits, or sometimes a rev share, a share of the revenue those players generate.
Okay, and how did they actually do that?
Well, they had a couple of main channels. One was their international iGaming affiliate network called PS.net. The sources actually mentioned PS.net won some top affiliate website awards in Europe a few times.
Oh, interesting. So they had some presence internationally.
Yeah, suggests they had some capability there, particularly outside the U.S. And that domestically in the U.S., they built out what they called direct-to-player, or DTP, state-specific affiliate websites.
Ah, targeting specific states where betting is legal.
Precisely. Designed to capture local traffic. The sources say they were licensed or operating in about 18 jurisdictions, which covered 17 U.S. states.
So a network of sites, international arm, trying to funnel users to betting platforms. I think the sources also mentioned some proprietary tech, analytics, optimization, that kind of thing.
Yes, they claim that. The idea was to deliver qualified traffic efficiently. But, you know, looking at the historical financials, which we'll get to in a bit,
Yeah.
that proprietary edge, while it didn't really seem to translate into strong, consistent financial performance, let's put it that way.
And scale-wise, were they a big name in the affiliate space?
Oh, far from it. Consistently described as a microcap. Before all this recent news, their market cap was tiny, somewhere in the, $1.8 million to maybe $4.7 million range.
Wow, okay. Really small.
Yeah, very small fish in a very, very competitive digital marketing sea. Their value proposition was pretty straightforward. Deliver qualified player traffic.
Sounds like a tough business to be a small player in.
It really is. And it's actually worth noting, before this massive crypto pivot, they were already doing some, let's call it, strategic housekeeping.
Oh, yeah. Like what?
Back in January 2024, they sold off their fantasy sports and game development units, got about $22.5 million for them.
Okay.
And they used a big chunk of that, $19.4 million, to pay down debt.
So getting leaner, trying to focus, that sounds like a company maybe trying to survive, right?
It does, yeah. They also changed their corporate domicile, where they're legally registered from Israel to Delaware around the same time. These moves, They really look like efforts to streamline and stabilize the original core affiliate business. Because, as the sources clearly show, that core business was struggling. Declining revenues, regulatory pressures. They were trying to focus and just stay afloat in their existing market.
So the key takeaway before the pivot, they were in a pretty precarious spot.
Exactly. This wasn't a company pivoting from some position of strength or amazing success. It was a company seemingly in a tight corner, which makes the scale and suddenness of what happened next even more, well, striking.
That context is absolutely crucial. Okay, so given that situation, who are the people trying to steer that ship through the storm? Let's talk about the management before this big shift.
Right. So the key executives running things were CEO Rob Fithian and CFO Robert DeLucia.
Okay.
Fithian has a background in sports tech, sold companies before. DeLucia, the CFO since August 22, his background seems particularly relevant given where the company was.
How so?
He has experience in M&A, raising capital, SEC reporting. Critically, experience in high growth and turnaround situations. The sources mention GTT Communications, Eastern Airlines, things you need when a public company is, well, struggling.
Yeah, makes sense. People experience in corporate maneuvers dealing with financial distress.
It really does fit the picture. And the sources detail their recent efforts just before this latest news broke, specifically dealing with NASDAQ compliance problems.
The dreaded delisting risk.
Exactly. SharpLink was running into trouble meeting NASDAQ's minimum bid price for the stock and also the minimum stockholders' equity requirements. Delisting was a real threat.
So how did they try to fix that?
Well, first, for the minimum bid price, they did a 1-for-12 reverse stock split. That took effect on May 6, 2025. Consolidate shares, boost the price per share.
Standard playbook move for that situation, yeah.
Right. Then, just a couple of weeks later, May 20th, just before the big news, they priced a $4.5 million public offering.
Okay, raising a bit more cash.
Exactly. The stated goal was working capital and, crucially, boosting stockholders' equity to help meet that NASDAQ rule. They'd actually gotten an extension from NASDAQ to get back into compliance.
So they were pulling all the levers, trying to satisfy NASDAQ, raise a bit of money, but basically keeping the lights on and staying listed, still focused on that original struggling affiliate business.
That's the picture, just days before everything changed.
Yeah.
But then, bam! Everything shifts with the introduction of a new key figure and a totally different strategy.
And that name is Joseph Lubin, right?
Exactly. Joseph Lubin, co-founder of Ethereum, founder and CEO of Consensus.
Consensus,
Right.
the company behind MetaMask and Fira. Huge names in the Ethereum space.
The very same. A giant in Ethereum software infrastructure. And the sources say he's expected to become chairman of SharpLink's board once this massive financing deal closes.
Wow. Okay, bringing someone with that level of credibility and deep expertise in blockchain into a company the size of SharpLink, that is unexpected, to say the least. It's a game changer. His background, his reputation in the Ethereum ecosystem, it's immense. The sources really emphasize that he's expected to provide critical strategic guidance, specifically on this new Ethereum treasury strategy and potential Web3 integrations down the line.
So his involvement is key to the market reaction.
Absolutely. It's highlighted as a major driver. It lends instant credibility to a strategy that, let's be honest, would otherwise seem completely out of left field for this specific company.
So you've got this interesting dynamic. The existing team, experienced in corporate finance, maybe turnarounds, but not crypto.
Right.
Suddenly bringing in a true heavyweight from the crypto world to basically set the direction for their main asset. It's a fascinating contrast in leadership expertise.
It fundamentally changes the game. The knowledge base, the priorities at the very top, completely different.
All right, let's talk money then. Chapter 3, financial health. From struggling microcap to this massive capital infusion, what did the books look like before any of this big money showed up? Well, as we hinted, the historical financials. They painted a pretty grim picture. For the full fiscal year 2024, revenue was just $3.66 million.
Okay.
That was down over 26% from the previous year. And the net loss from their continuing operations was $4.47 million.
Right. I saw the total net income looked positive, but that was skewed by selling off those other units.
Exactly. That sale made the bottom line look better than the core business actually was. The core business was losing serious money year after year.
The margins must have been bad then.
Oh, deeply negative. Gross profit margin was just under 31%, which isn't great itself. But the operational metrics, things like EBIT and EBITDA margins, basically showing how the core operations performed before interest, taxes, etc., they were both negative by over 125% in FY 2024.
Oof. Negative 125%.
Yeah, and Q1 2025 wasn't any better. Revenue down 24% year over year, Net loss increased over 107% year over year. That resulted in a net profit margin of negative 131%.
For those numbers, I mean, that sounds like a company in really serious distress. Even after selling assets, the core business was just bleeding cash.
That's the crucial takeaway from the financials. Declining revenues, persistent losses from core operations, even after asset sales. It underscores severe challenges. This wasn't just a rough patch. It was a genuinely precarious financial state.
And the balance sheet. Did they have much cash cushion?
Barely any. End of FY 2024, cash on hand was just $1.44 million. Stockholders' equity was $2.08 million, an improvement from being negative the year before, but still tiny for a public company.
Right.
And by the end of Q1 2025, cash and short-term investments had dipped slightly to $1.37 million. Debt was low after the restructuring, but total equity was still minimal.
So very little cash, minimal equity, facing NASDAQ delisting. That really underlines the desperation you mentioned earlier, doesn't it?
It absolutely does. And that's the backdrop for these recent capital raises. That $4.5 million public offering in May, it added a bit of cash, helped temporarily with the equity requirement for NASDAQ.
But the main event, the truly transformative one,
was the massive $425 million PIPE financing, announced May 27th. And this isn't just injecting capital. It's a fundamental reshaping of the company's balance sheet, its identity, everything.
Because most of that money isn't for the old business, right?
Correct. The sources are clear. The vast majority of these proceeds are intended specifically for the acquisition of Ethereum, ETH.
Okay, so let's imagine the dust settles. If we look at a pro forma balance sheet after this PIPE closes, based on what the sources suggest, what does this company look like financially?
Well, it's a radical, almost unbelievable shift compared to where they were. You're looking at a massive jump in assets, almost entirely ETH holdings. Estimates are around $415 million to $420 million worth of ETH, plus maybe a small amount of leftover cash.
Wow.
And correspondingly, total stockholders' equity is expected to explode upwards, potentially to around $420 million to $430 million.
That just makes the old financials feel like ancient history. The scale is completely unrecognizable.
Absolutely. And think about cash flow. Historically, their cash flow from operations was negative. They were burning cash. Q1 2025 used over $500,000 from operations. FY 2024 was negative $1.29 million.
So they needed financing just to operate.
Pretty much. They were using things like an ATM offering, selling shares directly into the market in Q1 just to manage cash levels.
So this $425 million PIPE, it's not just plugging a hole, it's completely redefining what the company is financially. It's going from a struggling affiliate marketer with almost no assets to becoming an entity whose primary asset is hundreds of millions of dollars in a very volatile digital currency. That radical shift may be born out of necessity given the old business. That's the core story here.
That's absolutely the core transformation.
Okay, if you're finding this deep dive valuable, maybe scratching your head a bit like we are, remember to head over to the Stock Analytics AI YouTube channel.
Yeah, definitely check it out.
Like this video, subscribe, and maybe think about becoming a member. It's just $4.99 a month, and you get your stock or earnings deep dive requests put right at the top of our list.
Okay, so we've got this struggling business suddenly infused with massive capital for a completely new strategy. Let's look at how the market actually reacted. Chapter 4, Market Sentiment, the rocket ship ignition phase.
Wildly. That seems like the only appropriate word. The sources describe this just astonishing stock price move. Okay, so mid-May, the stock's bumping around $2.96 and $2.96.
Right, post-split prices.
It closes at $6.72 on May 23rd. That's after the news of the smaller offering. But then, May 27th, when the PIPE and the whole Ethereum strategy hit the wire, just wow.
Yeah.
It opened at $33.93. It hit an intraday high of $53.45 and was still trading around $34.65 by mid-afternoon ET.
Good grief. That's an increase of over 415% just from the previous day's close. That's truly extraordinary volatility.
What were the main things driving that absolutely insane surge, according to the sources?
Well, it looks like a potent cocktail of factors. First and foremost, just sheer enthusiasm for this Ethereum treasury strategy itself. It's a really novel concept for a publicly traded company, right?
Yeah, definitely different.
Second, and maybe just as important, the immense credibility and influence brought by Joseph Lubin and Consensus being involved. As we talked about, his name carries massive weight in the crypto world. His involvement is absolutely key here.
Okay, strategy and Lubin. Anything else?
And then there was a major technical factor. The sources strongly suggest it was significantly amplified by a huge short squeeze.
Ah, the shorts got caught.
Seems like it. There was apparently really high short interest before this news dropped, One source mentioned around 71.55% of the stock's public float was shorted.
Wow, that's high.
It is. So when that price started rocketing upwards on the news, those short sellers were basically forced to buy shares rapidly to cover their bets, which just poured fuel on the fire.
So the current market sentiment, overwhelmingly bullish, clearly. But it sounds like it's almost entirely driven by speculation on this crypto pivot, the Lubin Association, and maybe technically amplified, but completely detached from the old business fundamentals.
Precisely. The old iGaming affiliate business barely seems to register in the market's reaction right now. And some sources do mention technical indicators, like the Relative Strength Index, or RSI, being deep in overbought territory, which, can be a sign that such a rapid climb might be unsustainable, at least in the very short term.
Okay, let's look under the hood of that $425 million. Who actually put up the money? Who are the players in this massive PIPE deal? Chapter 5, Ownership Structure.
Right, the sources detail the key investors. The lead investor is Consensus Software Inc. itself.
Lubin's company.
Yes. But it's not just Consensus. It's actually a whole consortium of pretty prominent crypto VCs and infrastructure providers.
Oh, like who?
The names mentioned include Parify Capital, Electric Capital, Pantera Capital, Arrington Capital, Galaxy Digital, Ondo Finance, and others. Big names in the crypto investment space.
So this isn't just one entity making a bet. It's a group of major crypto-native investors all coming in together.
Exactly. And collectively, they're purchasing 69,100,313 shares of common stock, or equivalents, at a price of $6.15 per share.
Now, there was that really unusual detail about the existing management participating too, wasn't there?
Yes, this is quite notable, and the sources highlighted. The CEO, Rob Fithian, and the CFO, Robert DeLucia, they also participated in this PIPE financing. But here's the kicker. They paid a higher price per share.
Higher?
Yes, $6.72 per share, compared to the $6.15 paid by Consensus and the big VC funds.
That's strange. Why would management pay more than the lead investors?
Well, the sources offer a couple of potential interpretations. One view is it's a very strong signal of management's personal conviction in this new strategy, putting their own skin in the game alongside these major players, and even at a premium. Shows belief.
Okay, I could see that. Any other read?
Alternatively, it might just be part of a more complex negotiation or structuring of the deal with the lead investors, maybe some specific terms we don't see. The sources don't provide non-public details, but it's certainly an unconventional move.
Yeah, definitely stands out. But regardless of the price paid, the sheer number of shares being issued here, it's staggering, right, compared to what was there before?
Oh, absolutely massive dilution. The sources really contrast the new shares, 69.1 million of them, with the tiny number outstanding before this PIPE. Even after that reverse split in the small offering, the pre-PIPE share count was only around 0.66 million, maybe 660,000 shares.
So going from under 1 million shares to suddenly having almost 70 million new ones.
Exactly. It fundamentally and dramatically changes the entire shareholder base.
So who essentially controls the company now, or will control it?
Well, the likely outcome, based on those numbers, is that Consensus and this consortium of crypto VCs will collectively hold a very significant, quite possibly controlling portion of the company moving forward.
And why does this ownership shift matter so much for you, the listener, trying to understand this?
Because the company's direction, right? Its capital allocation decisions, its strategic priorities, they're now going to heavily reflect the interests, the expertise, and the strategic goals of these new, predominantly crypto-focused owners.
So the old iGaming business becomes secondary.
Pretty much, unless they can somehow successfully align it with this new Web3 strategy, which honestly is not guaranteed. The whole focus shifts away from traditional affiliate marketing towards crypto treasury management and potentially exploring Web3 applications.
Okay, this pivot sounds incredibly exciting, especially given the stock pop and the big names involved. But let's get real. What are the major risks here? Chapter 6, Risk Assessment, Navigating These Crypto Waters, and maybe other factors too.
Yeah, the risks are significant, and they're almost entirely tied to this new Ethereum treasury strategy and just the sheer scale of this bet. The most obvious one, the inherent volatility of ETH itself.
Right, the price swings can be huge.
Exactly. SharpLink's financial health, its stock value.
Yeah.
They're now directly tethered to the price movements of Ethereum. If ETH experiences a significant sustained decline, it could lead to substantial, potentially devastating impairment charges on the company's balance sheet. Rapid value destruction is a real possibility.
And crypto regulation is still a bit of a Wild West globally, isn't it?
Absolutely. Regulatory risk is massive. The global crypto landscape is constantly evolving, often unpredictable. Unfavorable regulations targeting ETH specifically, or digital assets more broadly, could seriously impact ETH's value or its utility, directly hitting SharpLink's primary asset. Then there's execution risk.
Meaning, can they actually manage this?
Precisely. The existing management team, while they have experience in corporate finance and maybe turnarounds, they don't have a proven track record in managing a crypto treasury of this size. We're talking hundreds of millions.
So acquiring it, securing it, staking decisions.
All of that. Acquisition, custody, security, making decisions about staking or potentially deploying it in Web3 integrations. It's a specialized skill set. They'll be leaning heavily on Joseph Lubin and Consensus for guidance, which is critical. But the company still needs to execute flawlessly.
And what about trying to connect the old struggling business with this new crypto strategy?
That introduces integration risk. Can they successfully integrate the legacy iGaming business, which, let's remember, was struggling financially with potential Web3 synergies? Can they actually use this massive ETH treasury or Web3 tech to somehow revitalize or leverage the affiliate side?
Doesn't sound easy.
No, the path isn't clearly defined at all. Finding meaningful, profitable synergies could be very, very challenging.
Plus, as you mentioned, the heavy reliance on Joseph Lubin.
Correct. His involvement is absolutely central to the market's confidence right now and the strategy's credibility. If, for whatever reason, he were to reduce his involvement, or if Consensus's advisory role changed significantly, that could really negatively impact market sentiment and the perceived viability of the whole thing. Dependence on key personnel is a risk here.
Okay. They fixed the immediate NASDAQ problems with the capital raise, but are there still risks related to that old core business just sort of hanging around?
Yes, definitely. They haven't just dissolved it overnight. That core affiliate marketing business, it still faces all its previous challenges.
Like
Continued financial struggles, the declining revenues, the losses, intense competition from much larger media companies and nimble startups, the sheer complexity of navigating state-by-state licensing in the U.S. iGaming market,
right.
and just increasing operational hurdles in affiliate marketing itself, compliance, SEO changes, keeping up with tech, those haven't gone away.
What about those 2025 U.S. tariffs we've heard buzzing around? Do they impact a company like SharpLink?
Good question. The sources do mention the 2025 U.S. tariffs. The focus there seems to be mainly on physical imported goods, right? Things like gaming hardware, discs, especially from places like China, Mexico, Canada. Some very high tariff rates being discussed there.
So as an online service provider, SharpLink wouldn't be directly hit by those tariffs on physical goods?
No, not directly. They don't import or sell physical stuff subject to those tariffs. However, you could argue there might be some indirect impacts, potentially.
Like what? Maybe reducing the overall customer base if hardware gets pricey?
Exactly. If higher hardware prices make gaming consoles or PCs more expensive, maybe it slightly reduces the overall pool of active gamers over time. Or, perhaps more broadly, if consumers have less disposable income due to higher costs driven by tariffs across other sectors, that could maybe indirectly affect discretionary spending on things like iGaming and sports betting.
Which could then trickle down to operator marketing budgets.
Potentially, yeah. If the operator SharpLink serves see reduced demand, maybe they cut back marketing spend, which could then impact SharpLink's legacy affiliate revenues.
But how significant is that risk compared to the crypto stuff?
Well, the sources seem to suggest that these potential indirect impacts from tariffs on SharpLink are likely pretty muted compared to the sheer scale of the crypto risks and the magnitude of this pivot. The company's main asset, its primary value driver now, is overwhelmingly ETH. And that strategy, not its legacy affiliate revenue stream, which might be slightly nudged by hardware costs. The sources also use a phrase. They pretty accurately describe this new strategy as essentially a bet the company move.
Because they're putting almost everything into one volatile asset.
Right. Allocating the vast majority of the company's capital to a single, highly volatile asset like ETH is inherently high risk. There's just no way around that. There's potential for rapid, significant value destruction if Ethereum's price takes a major, prolonged hit.
And holding that much digital value? Cybersecurity must suddenly become a massive concern they didn't really have at this scale before.
Oh, absolutely. The sources explicitly introduce significant cybersecurity risk. Holding hundreds of millions of dollars worth of ETH makes the company a prime target for sophisticated digital asset theft. They're going to need exceptionally robust, specialized security measures, custody solutions. It's a whole new world of risk exposure for them.
And one last thing. What about the folks who just put in that $425 million? Is there a risk they might just cash out?
Yes, that's mentioned too. Call it shareholder exit risk. These large crypto VCs and consensus, they're coming in with specific strategic objectives, right? It could be about gaining public market exposure for ETH, maybe proving out a corporate treasury model, or other goals tied to their crypto mandates.
So they might not be long-term holders in the traditional sense.
Potentially not. The sources suggest there's a risk they might sell their large positions once their strategic aims are met, or if market conditions change, or if they simply find better investment vehicles down the road. And given the huge size of their collective holdings, any large-scale selling could create significant downward pressure on the stock price.
Wow. Okay, that's a pretty comprehensive list of risks, and almost all of them seem laser-focused on this new crypto-centric strategy.
It fundamentally rewires the company's entire risk profile. They've gone from dealing with, operational hurdles and market competition in a niche industry to suddenly facing large-scale market risk, regulatory risk, execution risk, and major security risks, all tied to a highly volatile, cutting-edge asset class.
Okay, let's try and bring this all together then. Chapter 7. Conclusion and revealing that hook question. Where does SharpLink Gaming actually stand now, after all this?
Well, in essence, it's undergone just a radical transformation. That's the only word for it. From this small, struggling iGaming affiliate marketer, it's morphed into a crypto-centric entity whose future value is now intrinsically, almost entirely, tied to the price of Ethereum and the strategic guidance of Joseph Lubin and Consensus.
So from an investment perspective, it's basically a new company.
That's what the sources clearly state. It's essentially a completely new company to analyze.
How do you even begin to value something like this now? Traditional methods, like looking at earnings or revenue multiples, they seem kind of irrelevant, don't they?
They mostly are, yeah. Traditional valuation based on the historical operating business metrics. Largely irrelevant now. The sources explain the valuation is now tied almost entirely to the net asset value, the NAV, of its ETH holdings.
So how much ETH they have times the price of ETH.
Pretty much that, plus some kind of premium. A premium based on speculation about the strategy's potential, the association with Lubin and Consensus, maybe future Web3 opportunities they might unlock. Yes, there was that massive dilution we talked about.
Right.
But the stock price re-rating clearly reflects this new focus, this perceived asset value, and the speculative premium on top.
Let's try looking at this through a different lens.
Yeah.
What about from a traditional value investing perspective? A classic Buffett-style view. How does SBD stack up in its new form?
Yeah, the sources actually address this directly, and they highlight some pretty significant misalignments with those core value investing principles.
Okay, like what? First test. Is it an understandable business?
Well, the old affiliate marketing business was maybe somewhat understandable, but this new model, it requires deep crypto knowledge, understanding Web3 concepts. It's far more complex and less tangible than simply selling clicks or leads, so less understandable for many traditional investors.
Okay. What about favorable long-term economics or having a moat, a competitive advantage?
The sources argue there's no traditional moat here based on, say, operational efficiency or market position. Any potential moat is now tied entirely to the unique position of holding this massive ETH treasury and having Consensus advise on how to use it. The long-term economics are almost completely dependent on ETH price performance and the success of that treasury strategy, not the old business.
And able and trustworthy management.
Tricky one. The existing team, yes, they handle corporate crises, they raise capital, but their direct, proven crypto treasury management experience at this scale, it's limited or non-existent based on the sources.
Yeah.
However, they are bringing in Joseph Lubin and Consensus for that expertise.
So the capability relies heavily on the advisors.
Exactly. It relies heavily on that new advisory structure, much more so than the legacy operational management team's specific skills in this new domain. Lubin is certainly highly capable in crypto.
And the final hurdle, sensible price with a margin of safety.
This is where it really diverges. At the current valuation, which is clearly heavily speculative and driven by market excitement for the crypto pivot,
Right.
the sources find it exceptionally challenging, if not basically impossible, to establish any kind of traditional margin of safety.
Meaning buying it significantly below some calculated intrinsic value.
Right. The current stock price reflects a high-risk, high-reward bet on Ethereum and the new strategy, not an investment bought below intrinsic value based on predictable earnings or easily valued assets outside of the volatile ETH itself.
So from a strict traditional value investing standpoint, SBET is a no-go right now.
The sources conclude that, in its current transformed state, SBET would likely be considered uninvestable based on those strict tenets, like Graham's or Buffett's. The new business model is highly speculative, Future cash flows are completely unpredictable and tied to a volatile digital asset, and there's just no readily discernible margin of safety at the current price.
So what's the long-term outlook boil down to then?
Highly speculative. That's the key word. It really feels like a binary potential. Either very high reward if Ethereum performs strongly and the treasury strategy is executed brilliantly, or very high risk for rapid value destruction if ETH prices fall significantly, or the strategy falters. And that legacy business, very much secondary now, unless they somehow manage that successful Web3 integration, which remains a big unknown.
Okay, so let's revisit that key question, the provocative thought we teased at the start, but now informed by everything we've unpacked from these sources. Here it is. Is SharpLink Gaming, in its new form, a genuine pioneer? Is it charting a brave new course for corporate crypto treasuries on public markets, a really bold move for the digital age?
Or is it simply a publicly traded vehicle for a massive, high-stakes bet on Ethereum? Just a gamble, wrapped in corporate paper, with risks that far, far outweigh the kind of certainty or predictability that traditional investors usually look for.
That really is the central tension in this whole story, isn't it?
It is. And the sources seem to suggest the market, currently at least, sees it largely as that bet on ETH, supercharged by the credibility of Lubin and Consensus, all packaged neatly in a public company structure that gives lots of people access to that bet.
So it really comes down to perspective.
It does, and it's now really up to you, our listener, to ponder which of those perspectives resonates most with you. And maybe more importantly, to think hard about your own risk tolerance and your understanding of the highly volatile crypto market when you look at situations as dramatic and fast-moving as this one.
An absolutely fascinating corporate transformation, driven by a huge injection of cash and a radical pivot into a completely new and very different asset class.
Indeed. It's a story of corporate reinvention, maybe born out of necessity, as we discussed, but with potentially groundbreaking ambition. Or perhaps just a groundbreaking level of risk. Only time will tell.
Well, that's all the time we have for this deep dive into the whirlwind story of SharpLink Gaming. Thank you so much for joining us.
Yeah, we really hope this helped you understand the complex layers of SharpLink's recent and very dramatic transformation based on the sources provided.
Remember to subscribe to the deep dive wherever you get your podcasts so you don't miss our future explorations.
And please do head over to the Stock Analytics AI YouTube channel, hit subscribe there, and definitely consider becoming a member for just $4.99 a month.
Yep, that's the absolute best way to let us know if you'd like us to do a deep dive on a specific stock ticker or maybe jump on an earnings report right after it drops. Member requests get prioritized.
I look forward to seeing those.
Just a final important reminder. This analysis was based only on the source material provided to us for this specific deep dive. We've used tools, including Stock Analytics AI, to help synthesize that information efficiently, but the content presented strictly reflects the facts and perspectives contained within those sources.
Absolutely. And none of this should be taken as financial advice. Situations like SharpLink's are inherently volatile, incredibly complex. Please, always do your own thorough research and consult with a qualified financial advisor before making any investment.